Welcome to The Explainer. Look, I am so glad you're here today because, well, let's just address the elephant in the room. If you've opened your portfolio at any point this week, you probably got blasted by a blinding sea of red. I mean, alarms are ringing, the timeline is in full meltdown mode, and retail investors are just panic selling left and right. But here on The Explainer, we don't do panic. We do structure. We rely on data. And honestly, we protect what we have. Today, our goal is to cut through all that emotional noise and the wild fear-mongering to find the objective reality of this crypto crash. We're going to look strictly at the numbers so you can navigate this chaos like a pro. So let's jump right in. Is the crypto bull market officially over? Honestly, this is the ultimate question every single new investor and even the battle-tested veterans are asking right now. And hey, when you watch months of hard-fought gains literally evaporate in a few days, getting a knot in your stomach is a totally normal reaction. It really feels like the music just stopped dead. So if you're feeling anxious, that is totally valid. The surface level price action is just brutal right now. But before we call an end to the cycle and throw in the towel, we have to understand the underlying mechanics of this drop. In this market, surface action almost never tells the whole story. We gotta follow the money. $1.3 billion, just let that sink in for a second. That is the staggering amount of capital that bled out of spot ETFs in one single week. We're not talking about retail traders getting spooked and selling a fraction of a Bitcoin here. This is massive institutional capital slamming on the brakes. Those spot ETFs were the giant engine driving the bull run all year, funneling Wall Street money straight into digital assets. So when $1.3 billion runs for the exit in 7 days, it creates a massive liquidity vacuum. It strips away the foundational buying pressure that was propping up the whole market, leaving prices incredibly vulnerable to a sudden drop. And the immediate result of all that institutional cash fleeing, Bitcoin crashes violently through $60,000, touching down into the 59K range. Now, why does 60,000 matter so much? Honestly, it's pure human psychology. That number was a mental fortress. Breaking below it isn't just a line on a chart moving down, it's a huge psychological blow that wipes out months of progress. It makes people second-guess everything. And worse, it causes beginners to rush. And listen, this is where we see some of the most heartbreaking digital wallet mistakes. People panic, they rush to transfer to an exchange, and they accidentally send Ethereum to a Bitcoin address. Or they pick the wrong network because they're terrified of losing another 10%. And just like that, poof, the assets are lost in the digital void forever. Panic breeds these costly, irreversible errors. But why did Wall Street flee in the first place? Let's zoom out. You see, the crypto market doesn't exist in a bubble. It's heavily tied to the global economy, and right now, the macro triggers are flashing bright red. Global oil prices are spiking, which instantly wakes up the terrifying ghost of inflation. And when inflation fears come back, the Federal Reserve steps in, threatening to keep interest rates higher for way longer than we thought. For risk-on assets like crypto, high interest rates are basically kryptonite. They make borrowing insanely expensive and push traditional investors back to safe, guaranteed yields like government bonds. That macro fear, that was the literal match that lit the fire under those massive ETF outflows we just talked about. And when the macro environment gets that tight, even the absolute titans of the industry start balancing their books, which leads us to a really fascinating event. MicroStrategy, the giant corporate holder of Bitcoin led by Michael Saylor, they sold 32 Bitcoin. Now, what's crazy here is the scale. 32 Bitcoin is a microscopic fraction of their multi-billion-dollar treasury. It's basically corporate pocket change, probably just standard bookkeeping. But the psychological impact of Michael Saylor's super bullish firm hitting the sell button sends shockwaves of anxiety right through retail investors. It was like this brutal psychological test, proving that in a fearful market, people will panic at a shadow. Okay, let's pivot and look at Ethereum, because this comparison shows us exactly the difference between what the panics crowd sees and what the objective data actually proves. On the surface, yeah, it hurts. Ethereum suffered a 23% wipeout over 30 days, thanks to 7 straight weeks of institutional ETF outflows. To the untrained eye, it looks like a complete disaster, but if you look beneath the surface, the underlying structure of the derivatives market is telling a totally different, incredibly healthy story. The surface is bleeding, sure, but the foundation beneath it is actually healing. Let me show you the hidden alpha here. This drop right here, this is arguably the most important data point in this entire explainer. The estimated leverage ratio just plummeted from 1.11 all the way down to 0.85. So what does this actually mean? Well, in crypto, leverage is basically borrowed money that traders use to multiply their bets. When leverage gets too high, the market turns into this insanely unstable house of cards. So this massive drop means millions of dollars in over-leveraged, highly risky, degenerate positions just got totally flushed out of the system. The gamblers got liquidated, their casino chips were quite literally swept right off the table. Which brings us to a really vital concept you need to understand: the foundation reset. Because this is exactly what we're watching happen in real time. The data shows net taker volume is severely contracting, which is just a fancy way of saying the aggressive short sellers, the ones betting on the price to drop, are officially out of gas. A foundation reset strips away that dangerous leverage, wipes out those overconfident shorts, and cleans up the derivatives market. It removes the toxic debt and sets up a beautifully clean, healthy slate for long-term spot buyers to step back in safely. I know the crash hurts your portfolio today, but this reset is absolutely mandatory for any sustainable growth down the road. So, knowing the foundation is resetting, we've got to ask the next logical question. With all this terrifying red on the screen, is capital actually abandoning crypto entirely? Are the big players packing their bags for good? Honestly, if you only stare at the daily Bitcoin and Ethereum charts, you might actually think so. But let's look a little deeper, because what the smart money is doing right now is fascinating. They're being highly selective. Enter our market outlier. While the traditional giants of the space are bleeding out and resetting, Solana is just flat out ignoring the macro crash. It's violently rebounding against the broader trend, pumping over 9% and aggressively reclaiming its $72 support level. Seeing that kind of strength in a sea of weakness is staggering. It proves without a doubt that capital isn't vanishing from crypto, it's just being incredibly picky. Money is migrating out of stagnant assets and flowing straight into ecosystems that actually have undeniable momentum right now. And that brings us to why Solana is capturing all that capital. It all comes down to the RWA, or real-world asset supercycle. We are seeing a massive wave of mainstream, traditional financial institutions issuing tokenized stock. That means real-world legacy assets are being officially represented on the blockchain. And the crazy part? They are completely bypassing Ethereum to do it. Why? Because Solana has lightning-fast execution and microscopic transaction fees that make corporate operations actually viable. Wall Street is actively exploring on-chain asset management, and Solana is perfectly positioning itself as the institutional darling of the altcoin market. That corporate adoption is exactly why its price is defying gravity. All right, let's move into our next section, the weekly strategy, navigating the rotation game. Let's start with the king, Bitcoin. Right now, it's trapped in a brutal, tight local range. You need to keep your eyes glued to two specific numbers. Your absolute line in the sand for critical support is $58,000. If we lose that level on a weekly close, the technical trapdoor swings open and we could see a much deeper correction. On the flip side, the bulls have to smash through the heavy psychological resistance at 62,000. Breaking and holding above 62K is the definitive trigger we need to confirm a proper trend reversal. Until one of those levels breaks, it's purely a waiting game. But even in this tense waiting game, there is a massive glimmer of hope. Traditional finance giants are watching this exact same setup. Standard Chartered recently noted that this capitulation event, this painful dip into the $59,000 range, could very well be the definitive long-term cycle bottom. They're looking at that total flush chart of degenerate leverage we talked about, and they don't see the end of the market. They see the ultimate, albeit painful, buying opportunity. They see this reset as clearing the runway for what comes next. Over on Ethereum, the setup is pretty precarious, but it offers a fascinating opportunity if you know what to look for. ETH is facing extreme downward pressure right now, rejecting off a harsh descending trend line. The absolutely crucial level to watch here is the $1,524 support line. If, and that is a big if, that 1524 support holds steady while the broader market finishes clearing out its leverage, it creates an incredibly attractive risk-to-reward entry, especially for patient swing traders waiting for the structural bounce. Watch that specific line closely this week. So, to survive this rotation game, you need a strict checklist, not just for trading, but for meticulously protecting your personal accounts. Because when volatility hits, vulnerability follows. First off, remember that capital is moving, not vanishing. Second, and this is absolutely critical for beginners, protect your digital perimeter. During crashes, phishing scams go through the roof. Hackers know you're stressed and checking your portfolio constantly. Double and triple check URLs before connecting your wallet to any dApp. Never click on airdrop links in social media replies. Third, secure your seed phrase entirely offline. The biggest mistake you can make is taking a screenshot of your seed phrase or putting it in your phone's notes app. Malware can drain your life savings in seconds. Get a hardware wallet, keep your keys offline, and regularly revoke old smart contract approvals you don't use. Finally, watch for those hidden structural resets, and always respect your absolute support levels. Don't let raw emotion or bad security habits ruin your financial future. Let the data guide you. Which brings us to our final thought for this explainer. You've seen the objective data. You know the market structure is actually healing right beneath the surface, stripping away the gamblers to build a truly solid foundation. You know exactly where the smart institutional money is moving, and now you know how to lock down your digital security to protect your assets during the storm. So the question is really up to you. Are you going to let the surface level fear push you to panic sell what might mathematically be the definitive bottom? Or are you ready to use the data, respect the technical levels, secure your wealth, and start playing the rotation game like a professional? Thank you so much for joining me today on The Explainer. Keep your eyes on the data, stay secure out there, and I will see you next time.